We'll talk about the final exam in general. I want to do it at the end. We'll talk a little bit about taxes just to wrap up what we discussed last time. We'll spend the majority of time on real estate investment trust. You'll talk more about real estate investment trust in the next course, which we're changing, by the way, a little bit. I think you will enjoy it more than the current course that is in place. And we'll finish with a topic which is basically discussing who does or does not benefit from real estate appreciation. Okay? Anything from you before we start? You just want to start. Oh, and I forgot the most important thing. After we're done, I'm following Arturo. And wherever he's going to have a drink, I'm having a drink too. And you guys are welcome. So I think it would be nice to have a drink or two after class today. It'd be fun, just to relax and have a different kind of atmosphere. I know you have a final exam to finish and all that, but if you're able to join for half an hour and have a drink, it can be fun. All right, so material. I want to talk about real estate taxes. And last time we talked a little bit about the technicality behind, so what kind of percentage you pay, how you depreciate things, what is the allowed depreciation schedule, how much do you pay on the capital, how much you pay on the income, all those kind of things. It's important. But it's also important to think about some of the reasons behind taxes and why people do or do not purchase different assets because of tax rules. And I just want to make a small comment about it. There's a lot of people that will tell you that the reason that they buy real estate, first of all, there's a lot of people in real estate that say things that don't make any sense. We already know that. And here's the following. Oh, I buy real estate because of the tax benefits. Okay? In most cases, a lot of them, they have no freaking clue what the tax benefits really are. And even if they do know, they don't see it in the big picture. I'm not saying everybody, but that is pretty common. For example, when people are telling you that they buy real estate because of the tax benefits when they're homeowners, they don't realize that what they can really declare in terms of deducting the taxes is only the interest and the property taxes. Now, today, if you have interest at 3% and you borrow $300,000, that's $9,000 a year, and you have property taxes of another $8,000, that's $17,000. That is coming instead of selecting your standard deduction, which is about 12.5. So really all you get is the difference between the 17 and 12.5, because now you can deduct not 12.5, 17, so you get this additional $5,500, and then you multiply it by your tax bracket, and maybe your tax bracket for that kind of person will be 25%. Basically, 25% times 5,500 will be, let's say, slightly less than $1,500 for $1,400. That is $100 a month. Okay, if this is the reason you are buying real estate, you taking things out of context. Okay, so that's one thing. The other, people talk about investments. You need to realize that in many cases, taxes are already incorporated into the prices. First of all, when we talk about residential real estate, because the government are giving us those tax deductions, real estate prices is priced higher than it would be otherwise. So we're all thinking that we're getting these $100 for free that we just discussed. You don't get it for free. Basically, because of those tax benefits, there's more people that buy real estate, and because of that, the demand for real estate is going higher, and prices adjust accordingly. So if the government would not, all of a sudden tomorrow, they would say, no real estate tax deductions for homeowners, so you cannot write off interest and property taxes, what do you think people will do? Some people on the fence between buying or not would not be buying houses, and people that would be buying real estate will be willing to pay a little bit less because now they don't get those benefits. The prices will go down a little bit. So yes, they would not get this benefit, but also pay a little bit less on housing. So really, it's a wash. So the idea of you receiving these tax benefits is not really based on very much. That's why I'm saying that, in my opinion, it's a very popular tax break because people love it, real estate agents love it. But in terms of actual value, really all you do is that you really are giving the money to those that own very, very, very large houses with a lot of interest and pay a lot of taxes, and those in the bottom getting nothing. Now, I do believe in capitalism, as I said many, many times, but sometimes those tax rates do not make sense. So that's my opinion on that, and some numbers behind it. Give you a little bit of numbers about taxes related to commercial real estate. Let's say that you have a situation where, example 1, you have a property with an income of 1 million, and the tax rate on that, to make it simple, is 30%. So net income is 700,000, and the sale price on that property is $7 million. Okay? If you have a property like that, that's basically selling for 10 times the net income, and you're saying that, well, you know, we have this certain tax situation, and people are paying usually based on what they're actually getting to keep, not on what the gross amount they're receiving, right? I mean, when you earn a salary or where you collect rent, whatever it is, you really care about how much you end up with, not how much you have in the beginning. So really, people, they don't care about the fact that they receive $1 million, they care about the fact that they get to keep 700,000. And based on that, they make a decision of how much they are willing to pay for property. So let's say that in this case, it is 700,000 their net income, and they're willing to pay 7 million, so 10 times. Now, if the government will come one day and say, you know what, we love supporting real estate investors, and we're going to say that this is a real estate investment, now the tax rate drops to 10%. It's not 30% anymore, it's only 10%, just to make it very simple. Okay? Then all of a sudden, you're going to have the same property that still gives you $1 million in income. All of a sudden, it is going to net 900,000 in net income. And people in many situations actually see if real estate has a favorable tax structure, so all other assets, let's say you have to pay 30%, but in real estate you have some deductions, all that, you're getting paying something less, let's say 10%. This is a reason to buy real estate. What they don't realize is that at the same time, the price of what they pay for the real estate also is going to be about 9 million. Basically, they get no benefit whatsoever. Okay? Yes, they're going to get an asset that's going to net more, but they're also going to pay a lot more for that asset. So the fact that now they have more favorable rules in terms of taxes, how much they need to pay, does not really help anybody. Now, it helps people in the transaction. So basically, if I held this property before the government said we're going from 30% to 10%, then yes, I instantly made $2 million because now my property went up from 7 million to 9 million. But this is, yes, at that point where tax rules change surprisingly over one day. Usually those things are not changing over one day. It's a long-term discussions and a fight between different parties and lobbies and all that, and you kind of know that those things coming, so price adjusted slowly over time. But basically, in this simple example, yes, you do not get benefit. Just because you get to keep more doesn't mean you're going to have higher return, because you will also pay more for the property. So the whole idea, the same thing also happened with housing, not just with commercial real estate. Yes, just because the government is giving you a tax break doesn't mean that you really benefit from that. It's already incorporated in the price. It just has to. You don't seem very excited about that, but questions? Okay, this is just my 2 cents about wrapping up the topic of taxes. So the next topic I want to talk about, and that will be a topic we'll spend a lot more time on, is real estate investment trust, REIT, and in plural, REITs. And so far in this course, the only way that we discuss that we invest in real estate is basically buying direct real estate. So you buy, for example, an apartment building, you rent to people, you get a certain NOI, and basically from those cash flows you generate some rate of return. Okay? There's at least 2 more common ways that people invest in real estate. So of course the other side is the debt side, and you'll cover that in your real estate finance course that you're starting in a couple weeks. So that is basically buying debt rather than buying the actual equity, the real estate. You actually buy the debt side. And then there is the indirect way to invest in real estate. So instead of buying real estate properties on the market or debt directly from the market, you buy it through some kind of vehicle, and the most popular vehicle to do that is real estate investment trust. So I want to spend just a little bit of time today talking about what real estate investment trusts are and how we value them. And then in the next course, we'll talk a lot more in details about providing different modeling and more precise estimations. So let me start with some definitions. So first of all, what a real estate investment trust is, it's a pass-through entity that distributes most of its earnings and profits to shareholders. Okay, so basically we're talking about a pass-through entity. It's basically a financial vehicle. This company, with the investor or trust, they're basically making money, and the majority of the money that they make, they basically give to their shareholders. They are not allowed to keep it within themselves like other companies. Other companies, and I'll give you some examples, they're allowed to keep a lot of the money in the firm for whatever reasons. In this case, no, they're making money and then giving to shareholders, and you'll understand in a minute why they have to do that. Some advantages over other firms is basically do not, okay, so put it differently. No double taxation. It's that simple. Talking about no double taxation, here's what I mean by that. If you invest in Coca-Cola, or in Caterpillar, or in Boeing, or in Deere, or in Lockheed Martin, whatever it is, company, Apple, that are not real estate investment trusts, the company, hopefully, is making money. And when they make money, they pay taxes, because okay, that's what companies should do, right? They make money, they pay taxes. And then, you as the shareholders of those companies, when you receive a check, dividend, from them, whether you deposit in your account, you receive a check, then you're going to pay tax on that again. So the company is paying taxes. Whatever left, some of that they still distribute to you. You're going to pay taxes on it again. Even if they don't pay you dividends, you would still pay taxes on any amount of money that you make because you bought the share, for example, for $40, and then you sold it for $50, so you made $10, and you had 1,000 shares, so you made $10,000, and you need to pay taxes again. So the company is first paying taxes at the firm level, whatever is their tax rate is, and according to their, all deductions or whatever it is they can do, but they pay taxes first, and then you as the shareholder are paying taxes again. So it's double taxation. In the case of real estate investment trust, none of that. Basically what happened is that the company at the firm level is paying no taxes whatsoever. Zero. None. And then they have to give the money to you, and then you pay taxes on those. So you pay taxes one time rather than twice. That is the biggest advantage of real estate investment trusts from the tax point of view. And again, the reason that the government is trying to do that is because they're realizing that a lot of people want to have exposure to real estate, but they either not wealthy enough to do that. Usually to invest in real estate, you need to have at least a modest amount of money. You can't just invest with $2,000, okay? In this case, you can, but when you buy direct real estate, you can't just invest a very small amount of money. And even if you do have enough money to invest in real estate, some people just don't have the expertise, they don't have the time, so they just don't. The government said, well, we want to make sure that there is some vehicle for people that don't have the expertise and don't have the time, and maybe don't have a lot of money to still be involved in real estate. Well, they can do that via real estate investment trust. There are other tax advantages of they can accelerate the depreciation differently than individuals, all those details. I don't want to get into that, but the basic thing is that they don't pay taxes at the firm level. In order to not pay taxes, they have to do certain things, right? They don't just, not everybody, of course everybody wants to not pay taxes, so the government says, okay, to be qualified to be a REIT, you have to do the following things. And again, those documents are very long and written in very complex and legal language, but we're going to summarize them based on the three main things that you have to do. So first of all, 90% of taxable income must be distributed. So remember when we talked about last time about taxable income, you are deducting all the things that you deduct, all the expenses, depreciation, interest, all those kind of things. You get the taxable income, and then you pay tax on that. It's individual. Well, in this case, they do all those things. They deduct all the expenses, depreciation, interest, and that. They get the taxable income, and then they don't pay tax on that. They have to take that amount and give at least 90% of that to their shareholders. Okay, so they still calculate the taxable income. Let's say for a particular company it's $10 million. So $10 million, that means that 90% of that, which is $9 million, they have to take at least $9 million and give to shareholders. They have 100 shares, they divide 9 million by 100 shares, and if you have 2, you get your share, and you have 3, you get your share, and so on and so forth. Yes?
The 10% they keep, is that like retained earnings? Is that
so they can keep that as retained earning, and they don't have to, but yes, in many cases they keep some of the money because they want to grow the firm, they want to develop more properties, they want to do whatever it is. Now you also have to realize, and we'll talk about it a little bit later, but basically, even though let's say that they are paying 90% and they keep 10%, they're really keeping a lot more than 10%. Why, if they pay you 90% and keep 10, they're really keeping more than 10% of the cash flows?
Because they're only giving you 90% of taxable income.
Because they only give you 90% of taxable income. There's at least one item there that is non-cash expense, your depreciation. There is one big item, and you'll see it in the slide there, that basically says, okay, you're allowed to depreciate your assets by $20 million this year, so that's increased the amount of taxable income, and then they didn't really pay anybody $20 million, they just get to write it down, and therefore they don't have to pay you 90% of that $20 million. They can basically keep it within the firm and do that whatever they believe that it's appropriate for the firm. And that's also what you will see, that sometimes they would pay 120, 130, 150%. Kind of like, how can you pay 150%? Well, because you pay 150% of the taxable income, really of all your cash flows, you can pay more than that. The second thing that they have to do is that 95% of gross income must come from rent, gains on real estate, dividend, or interest. So basically they're saying, well, you have to be a real estate type company. So what you're receiving, how you make your money, is coming from, I cannot even read my handwriting. How are you guys doing there? It's good that I'm speaking, but like I said before, I also have an accent when I'm speaking, so. Okay, so 95% of income must come from rent. So they have to basically have actual physical properties on which they collect rent, or gains on real estate. So basically they bought a building for 10 million, then sold it for 12, so they make money that way. That's fine. Dividends, meaning they hold other firms, and the government allowed that because they say, hey, it's fine, you can hold those other firms because those firms already pay taxes, so we'll allow you to generate money that way. Or interest, because a lot of those real estate investment trusts are actually holding debt. They're charging people interest rather than charging people rent. So all those are basically related to real estate. They have to be vast majority of the firm. The earning has to come from real estate related activities. 95%. Yes, Pedro.
The gains on real estate, the dividends. They're holding real estate companies, or could it be any
They can hold any company.
any company?
Yeah. It's not very common, but it can be. And really, the reasoning behind is the government saying, well, those companies that pay you the dividends already pay taxes, and then you're going to distribute to your shareholders, so they're going to pay tax again. We're already going to get our double taxation anyway, so it's fine if you're making money from dividends. But it's not very common that an apartment, a REIT that, especially an apartment, will own Coca-Cola. I mean, why would they? It just doesn't make much sense. Not in large quantities. I mean, just so they can. It's just not what they do. And then the last one, 75% of value must be real estate, cash, or government securities. Okay, so basically the way that you generate your money has to come from real estate, and then the vast majority of what you own has to be real estate related. So basically real estate, which it's real estate, that's the kind of purpose of this company. Cash, it's fine if you own cash, because you're not going to make any money on this cash anyway. And the idea that the government is allowing you to hold cash is because they don't want to force you to invest in things just because you have the cash. They want to allow you to have the time to, okay, I have some cash on the side, and I'm looking for investments. Nobody want to force those companies to invest things immediately. So having cash on the side is fine. And then government securities, again, because it is from the government is allowing, sure, you want to lend us money at low interest rate, we'll allow you to do that. Okay, those are the three main things they have to do in order to be qualified as REIT. If they don't do that, they can basically be put on probation, and then they're losing their REIT status. And gaining REIT status is pretty hard to do, so companies that get it one time, they're working very hard to keep it. Okay, so
in the REIT status, is that from just large holdings, or to earn REIT status? How do you start it?
like
You got a bunch of money and say I'm REIT.
you basically have to do those three and file a lot of paperwork. I'm not a lawyer, so I'm not sure about the exact procedure behind it, but basically, yeah, like anything else, it's paperwork, and if you're qualified, and you're going to get it REIT status. So some of them are publicly traded, like the one we're going to look at today, but some of them are private. You don't necessarily need to have a lot of money to start one, but because the effort to start one is so big, you're not going to do it for a small holding. It's, there's just some things, just the cost of maintaining and reporting and complying and filing all the paperwork and all that costs you so much money to have all those accountants and lawyers on hand. You're not going to do it for investment of, $10 million. It just doesn't make sense. You need to be large enough to justify all those costs along. So there's no minimum, I don't think there's a minimum amount that you have to invest, but from a practical point of view, it has to be large enough, because if not, it just doesn't make sense to have all those things that you need to do that you wouldn't have to otherwise. Would eat too much of your profits. Yeah.
So then what would you do in place of that if it was something under 10 million?
You don't have a REIT. You would have
Do a normal
LLC or
Okay.
whatever form of corporation you want to have.
You heard of a company called Rich Uncle?
Rich Uncle.
Yeah. It's like the mutual fund equivalent of a REIT, and they only invest in, they only have all of their properties are triple net properties around the U.S.
Yeah.
So, like Walgreens, McDonald's, blah, blah, blah.
I've not heard about Rich Uncle.
Their minimum investment size, I think, is like $2,500.
Send me there's a lot of those that are small and have a lot of PPPs too.
Yeah.
Send me a link. I'm interested in
They're
taking a look.
huge. Yeah.
Okay, I'll take a look. So who cares about those rates and who wants to invest? So first of all, we're talking about insurance companies and banks. So a lot of insurance companies or banks, They have a lot of very strict regulations on what they can and cannot invest in. Basically, the government is looking very, very closely at what they hold. They cannot have too much risk, which makes sense because if they are investing your money, and then you come to the bank one day and you say, hey, I want my money back. I say, well, sorry, we lost it last week because that they can't do that. Same thing with insurance companies. How do you think insurance companies make money?
I'm not
When you
saying.
don't file a claim.
Yeah.
No, by investing your money.
Basically, the way that the business works is that if you have, let's say that you are likely, or the average person is likely to get in an accident with their car, for example, every 20 years. And let's say that the cost of the average accident over 20 years is $100,000, for example. Basically, that would be $5,000 a year that they would then need to pay you. So the insurance company will do this calculation. Basically, they say, okay, we're going to charge you $5,000 every year, the average risk person. Then after 20 years, on average, we're going to collect $100,000, and we're going to pay it back to you. And it's like, so how are they going to make money? The way they make money is time value of money. They get to keep this money until they pay it to you. Okay, so the way that they do it is that, yes, they're figuring out what is that they need to pay you on average. They collect that slowly over time. Then, of course, they're paying back because people do get in accidents, and hurricanes do happen, and people do have fires in their homes, and all. I mean, they're, silly to think, okay, nobody's going to have claims. People are going to have claims. The money is going to be flowing back, but the idea is that in the meantime, they're going to invest it. But again, they're very limited in how they can invest it because they cannot charge you $5,000 a year for your car insurance, and when something happens, they say, well, sorry, can't pay you because we lost it in something else. So part of what they can invest in is real estate, except that those companies, they're not real estate companies, and they're not real estate experts, and they don't want to be real estate experts. They want to be banks, and they want to be insurance companies. That is what they are. So what they do, in many cases, they buy real estate investment trust. That's how they gain the exposure to real estate, but at the same time, they are free of management. Somebody else is managing, somebody else is selecting, somebody else is running the business, and they're getting the benefit of having exposure to real estate. So for them, it's something that they desire. Then you have pension funds. The same reason. Pension funds, they become a dying breed, but it used to be that a lot of people that work in a place for many, many, many years and then get a retirement. Basically, they put money into some fund and then they're receiving some salary after they quit their job for the rest of their life. But that was a lot more common in the generation before us, where you work in the same place for 30 years. Okay? Today it's not very common, but still, you still have some of those funds. And a lot of those funds, they want to make sure that they have relatively steady returns, and they don't want to be in the real estate business, but they want to be exposed to real estate, so they're buying some of those risks. And then the last two here would be individuals and developers. And those two are investing in those real estate investment trusts from two different points of view. So individuals, those are passive investors. Basically, again, if I want to have exposure to real estate, but I know nothing about real estate and don't have time to deal with real estate, well, I just buy shares of companies that hold real estate. I get the exposure, but I don't get a call in the middle of the night that the faucet is leaking or something is, some problem with the toilet or whatever it is. I don't need to select, I don't need to manage them. I'm basically passive. I just collect the returns. So that's from the individual perspective. On the other side, you have the developers or people that actually produce certain products. In many cases, if you want to develop something and you want to have an immediate investor to invest in whatever it is you develop, you can do it through REITs. So you are the kind of person that actually create the assets, and then people that invest in those REITs basically will be your immediate buyer. So there's a lot of those companies that, yes, they have, for example, they hold apartments or they hold offices and all that, but they also develop those offices. They also develop apartments. So basically, immediately when they develop them, they don't like, okay, where are we going to get the money, who are we going to sell it to, whatever. They already have investors in place. So that is the other side of the equation. types of REITs. We have, I'm very popular tonight. We have equity, we have mortgage, and we have hybrid. Those are the three types of REITs that we have. The equity are those REITs that actually physically hold, they hold physical real estate. They hold apartment buildings, office buildings, timber lots, industrial spaces, maybe more than one kind, different places, one location, whatever it is, they actually own. They own actually physically, they own physical real estate. Those are the equity. Then you have the mortgage type REITs. Those are the kind of REITs that they don't own any physical buildings. They basically own pieces of paper. So they basically lend money or buy mortgages from people that lend money to people that own real estate. And basically, I hold that this piece of paper that says that you're gonna pay me, $5,000 every month for the next 30 years because that's what you agree with your whoever initiated that mortgage for you. So if I hold your paper and I'm holding your paper and your paper and your paper, I basically have a pool of people that basically will pay me every month money because I own their loan. Of course, I paid money to hold this piece of paper, but that's how they make money. They try to buy them for less than what they're worth. And then you have the hybrid, those companies that do both. They own physical real estate and they own papers, basically debt. The last kind is not very common, and the reason it's not very common is because these two businesses are so different. Investing in physical real estate, investing in paper is a whole different business. The equity side is really real estate, and the mortgage side is more of being like a banker. It's a very different kind of business, so most companies usually stick to one. There are some that do both, but usually they pick one or the other, but they can be hybrid.
I have a question.
Yeah.
So an equity REIT would say they would participate in the equity side, right?
Uh-huh.
And the mortgage, there would be, let's say you're trying to get a construction loan or any kind of loan to finance a property, then you would go through a mortgage REIT?
You don't have to, but you can.
Yeah.
You can get the money from wherever you want.
Okay.
You can go to the debt market, you can issue a bond. You can go to the bank and get a line of credit or a mortgage, or you can go directly to a mortgage REIT and get money from them. So it's your choice, whatever.
But it would be a mortgage REIT, not an equity REIT.
Yes, because, yeah. And the why invest? Let's talk about a few of those. So, first of all, it's easy to diversify. So, if you think about it, one of the biggest disadvantages for real estate is the fact that most people cannot diversify with real estate. You need to be extremely, extremely, extremely wealthy to diversify real estate. I'm not saying you have $10 million or $100 million. That's not enough. If you want to be holding real estate in different places, forget about the world, different places in the United States, of different types, some offices, some apartments, some industrial, some whatever it is, in different states, and of different classes, some A's, some B's, some C's, you better be a billionaire. Okay? Any billionaires here in class? So you can take advantage of investing in REITs. So if you have just $10,000 investment, for example, you're able to still diversify using REITs because you'll buy with $2,000, you buy one REIT that have apartments in different places of the country, and another $2,000 you'll buy another REIT that have offices and industrial and so on and so forth. Then basically with $10,000 you have a diversified investments. You cannot do that with buying direct real estate. People that are wealthy, that have, let's say, 100 million, and 100 million is wealthy, they're usually investing in 1-2 cities, and they usually have maybe 1 or 2 kinds of real estates. You see a lot of basically, wealthy people that worth $100 million, they would be investing in Miami and maybe one more city that makes sense for them. Not more than that. But if you really want to get diversification, You either have to be extremely, extremely wealthy, or you have to go through REIT.
And do you know any better than?
I do not know. Well, met some, but know them. I don't know how you would. I have a picture with Warren Buffett. I had lunch with Buffett a couple of years ago. Yeah, like literally sitting like that far from him and have a conversation for about 45 minutes. So that make me, he probably not recognize me today, but when I was teaching, when I was at the University of Kansas getting my PhD, I taught a class that was called How to Invest Like Warren Buffett. It's kind of, well, don't you first need to prove that you can do that and then teach the class, but the idea was basically focusing on the investment types that Warren Buffett does, and then at the end of the course, we went to Omaha, which is pretty close to Lawrence, Kansas, and we met with Mr. Buffett. He gave us about 2 hours of his time answering questions, about an hour and a half of answering questions, then took us for lunch. So it was a great experience.
Doesn't he charge for lunch?
He bought us lunch.
No, but he charge. I think there's like they go for like 100,000 or so to have lunch with him for like 2 hours.
Well, no, I didn't go through that way. Yeah, you can also buy time with Warren Buffett, and then he donated to charity. I did not go that route. I basically applied through writing a letter and say, hey, I'm teaching this class. Would you please give us some of your time? And we made a presentation for him and all those kind of things. So it was a fun experience. It's a bit more difficult to do it when you live in Miami than it is if you live in Kansas, but most things are the other way around. So I guess that is one of the few benefits there. Anyway, is it diversified? Now, when you think about diversification, you diversify in two ways. Type, location, class. That's pretty obvious. So type of real estate, so office, industrial, retail, apartment, etc. Location, different places around the United States, around the world. Class, different classes of real estate, A, B, C, etc. But then what people don't think about is time. Again, we'll talk about a lot more in the next course when we talk about how to model, time diversification. But basically, the idea of diversifying through time is the fact that if you want to invest, let's say that you make a decent salary and you say, well, after I spend on whatever else and after I invest in other things, I have $2,000 every month that I want to invest in real estate. Well, if you invest directly in real estate, what do you need to do? You collect these $2,000 in month 1, month 2, and month 3, and maybe collect for 2 or 3 years. Then you have a significant amount of money, and then you go buy real estate with that. Okay, so you have to buy basically all at one time. And maybe that time that you bought, maybe was not a good time to buy real estate. Okay? On the other hand, here, what you can do is that you say, okay, if you have $2,000 every month you buy real estate investment trust worth of $2,000. You buy a few shares this month, and a few shares the next month, and a few shares the following month, and so on and so forth. So you basically buy real estate slowly over time. Your money never sits idle. It's never just waiting to be invested. It's always invested. And you never buy with all your money at the wrong time, because some of those times that you bought were the good time to buy real estate. Some of them not so much a good time, some of them bad times. On average, you buy at a on a time that is good on average. Okay, so the fact that you can diversify through time is also very important. Also, on the way out, if you have, let's say, your investment is basically tied in one big investment that is $5 million of real estate, and you want to liquidate, what do? In most cases, if you just want to liquidate, you sell it. And it's very hard to sell 1/10 of a building. Now, you can, right? I mean, you can have those agreements that you're going to have only 10% share of this building, but people don't do that. It's just headache, a lot of paperwork. People don't do that. So you either sell it or you don't, unless we're talking about like really big deals. But if you talk about a $5 million building, you either sell it or not. You don't sell 10%, and then next month you sell another 2%, and next month another 3%. You don't do that. You either sell it or you don't. So basically, you either invest it or not. In this case, if you have $5 million worth of real estate investment trust shares, let's say it's 100,000 shares, you can sell 100 of them this month and do that whatever you need to do, whether it's your expenses or spend whatever you need to spend. The next month you sell another 200 shares, another 150 shares, another, and so on and so forth. You can liquidate it slowly over time based on your needs. And some months maybe that you don't need to liquidate, then you don't. But basically, you can liquidate it slowly over time. You can accumulate it slowly over time. it is a big benefit.
Quick question, if, the REIT decides to sell one of its assets, do the shareholders get paid out dividends, or they would, I guess, reinvest into another property and nothing will happen?
The real estate investment trust will have to distribute the majority of those profits if they have. Yes.
So they wouldn't, they can't just retain whatever earnings they got and then reinvest into another property?
Well, depends how they do that. Sometimes they can use vehicles like 1031 exchange and likes that they can do that. But basically, if they sold it for a gain, just basically because they sold it, then it becomes part of their taxable income, then you have to distribute that. But if they are selling it at the same time, basically investing somewhere else, then they can do that.
I think that's part of the reason why they're not as attractive as probably with real estate investment, that they cannot like be entrepreneurial because the money they have to always first distribute to the investors.
It is part of the disadvantage, I guess, but historically you will see that they did extremely well. So they have very, very high returns. Yeah.
There are some funds that have a life of 10 years. By law, we need to sell that asset and then reinvest.
Yes.
Where does it fall?
No. They don't have to. They don't have a timeline. Yeah. The next one is you can invest small or large amounts. Now, small amounts, we already talked about it. So yes, you're the kind of investment, I just want to invest $500 every month. Or every paycheck, I'm going to invest $1,000. And you can do that with REITs. You can't do it with actual real estate. Somebody come to you and say, hey, I want to buy real estate, we have $500 this month. You find me something, you love it. But with REITs, you can do that. So this is the kind of us. Okay, I want to invest a few $1,000s every month. Okay, we can do that. But a problem, believe it or not, is also for the large guys. If you want to invest a large amount of money fast, it's very difficult to do in the direct market. So if you think about, if you're an insurance company or bank or any company have a lot of basic cash flow or need to invest money for investors and need to be or want to be exposed to real estate, and let's say they have to deploy $500 million quickly. If you want to buy $500 million worth of real estate in the next month, you can't do that. First of all, just the process of due diligence and finding the properties and all that is taking more than a month. It can take months. And secondly, if you're really rushing into, hey, I need to invest this money quickly, you're not going to find good deals. You're going to be overpaying because you're going to buy the first thing you see, and usually sellers have a tendency to recognize those things, and they're going to basically charge you full price. You cannot do that. The same thing also with selling large amounts. If you're selling large amounts, dumping, hundreds of millions of dollars in the market at one time, and you want to do it quickly, you would have to sell at fire sale prices. You cannot sell hundreds of millions of dollars quickly and get fair prices. You have to reduce your prices in order to sell it very quickly.
Let's assume I have a property and I sold it to a 1031 exchange. Then I get those funds and I invested in it. Is that allowed? Because technically I'm buying property.
Yeah, yes and no. No, under very certain situations, yes, but not for the common investors. No. There's some way that you can become, basically you can sell those assets directly to those REITs. So instead of selling them and then buy shares, you can basically say, look, I have $50 million worth of real estate. I'm just going to give it to you, and you're going to give me shares. You can do that. And then you can sell those shares slowly over time. And you don't pay taxes unless you sell them. So you basically exchange the assets for shares. It's a lot less common that you just sell to somebody else and then buy shares. You basically would need to be big enough to say, hey, look, I have all these properties. You want them? You agree on a price. They give you a certain number of shares. Instead of cash, they give you shares. And then you can do those shares whatever you want. So large amounts, basically, yes, if you want to either dump large amount of money worth of real estate, or if you want to get into the market with large amount of money, you cannot do that with direct investments. It's very difficult to find $500 million worth of real estate in a short period of time. You can easily do that through REITs. REITs are, the market value of REITs is in the hundreds of billions. You can easily put $500 million to work tomorrow. No problem. You can have your money invested in real estate, diversified, $500 million tomorrow for very short, very low cost. You know, cost you a few dollars for a trade. That's it. So I know it's not a problem that we worry about. How can we buy $500 million tomorrow? But some people or companies are worried about it, and they can do that. And of course, liquidity, which is already related to the things we talked about, is the fact that you can basically sell or buy it anytime you want for market price. Okay? If you want to buy or sell property in the direct market, in market price, you cannot do it very quickly. So if you have a property that is worth $5 million, you want to sell it, it takes you a while until you get $5 million for that. Weeks, months, years, depending on the market, you don't do it within a second. Here you can click and it's done. So liquidity is definitely an advantage. Now it has all those benefits, has a few more, but those are the main benefits. And people think about, okay, so we have all those things that you don't have with direct real estate, then what is the catch? What do you think the catch is?
Transaction cost?
Transaction cost is very minimal, part of liquidity. Okay, so let me put another one here. If I want to invest $100,000 in REIT tomorrow, it costs me $5 from my pocket, $5. Not 5% of $5, which is nothing.
So the underlying asset,
You can use your money, it's basically locked in.
Guys, what? No, it's liquidity. You don't have your money locked. You can sell it any moment you want.
Does the management for your making all the money or no?
Well, you would know that if you wouldn't get fair returns, right? If they had all the money, you'd stop investing in them.
When I say all the money, compared to...
Well, there's some management fees and all that, but actually with the public traded REITs, they're actually not bad. In the private ones, they are really bad. That's where they really take all your money.
but isn't one of the reasons why we just went through a great recession? The REITs, they have toxic assets.
No, that is the CMBSs. Those are the banks. Some of the mortgage REITs did some of that, but actually they bought it from other institutions that initiate it. Guys, the answer is simple, I think. Well, when you get all those benefits, you assume that, yes, I'm getting all benefits, but I have to pay somewhere. And the way that you pay is usually that you're getting smaller return. You say, look, I can invest directly, let's say, and make 10%, for example, or I can invest indirectly and have less headache, I can be diversified, I can invest small, big, liquidity, low transaction costs, but I only make 8.5%. Okay, so that's usually the argument of, yes, you get all those benefits, but there's a cost that usually come in a form of smaller return. However, even though the theory makes sense that, yes, you get all those benefits, you're going to get lower returns, the evidence is very, very different. REITs become REITs. Defined the way that we just defined them, all the tax benefits and all that in 1993. Since 1993, they actually outperformed any other index of direct real estate investments. So not only that you got higher returns, you also got all those benefits at the same time. So I'm not saying that it will continue. There's a lot of research being done about that, why it cannot continue, but at least historically, you didn't even pay for that. You basically got all those benefits without paying for that. I think part of that is basically because real estate investment trusts were unknown. People were uncomfortable investing in them, and therefore they're selling for very low prices. As people become more comfortable, the prices are going up, and then, yes, all those benefits will be incorporated in the price. So theoretically, it should be, and it probably will. It just takes time. 993, yeah, it looks like it's a long time ago, but it's really not a time. It's really not a long time period. Think about, people adjusting to a new type of investments and pricing correctly and all that. So the return on those actually happen to be very, very high, in the low to mid teens on average. Yes.
No lower
mid-teens, so 12, 13, 15% on average. The returns were more than 10% on average year after year since 1993, which is very high. Yes?
Did the REITs have anything to do with helping the real estate market bounce back by buying up all the foreclosures?
Yes.
Those were just equity firms. Okay, so it
Yes.
was REITs.
Yeah, so
That
a
was
lot,
a thing,
not,
right?
not only, but a lot of those REITs, basically, yes, they're
Foreclosed property.
one of the very new classes. That's a good question. One of the very new asset classes that basically started existing after the Great Recession was single-family holdings. Until the Great Recession, you'd see no REITs or no really big companies holding single-family homes, none. Because, oh, you know, I don't want to have a house that is one here, another one here, another one there, and this one is paying white, another one paying off-white, and this one has this kind of, I want to have those 400 apartments in one place that I know that they all look the same. I can put manager in one place and all that. So they never own single-family homes until the Great Recession, where, well, the price was so low. It's like, yes, at a certain price, I'm willing to buy a property here and a property here and a property there and make a collection of them. And yes, the management is more involved and more difficult to do, but the returns were very, very high. So part of that, buying a lot of those assets in big quantities, basically in bulks, a lot of them were REITs.
And that's what brought inventory down low. And
Yes. Thank you, Arturo. Let me show you two REITs. We go to meeting 7. And you go to O stock report, for example. This is a report that basically evaluates a real estate investment trust called Realty Income Corporation. Okay? And I don't really care particularly about, you know, what their opinion. I just want to show you a few things. So, a few things. First of all, those companies are always reporting, those reports, or the way people refer to real estate investment trust, they refer to them in terms of FFO rather than EPS. Okay, everybody know what EPS stands for? Earnings per share. Those companies, they don't talk about earning per share, they talk about funds from operation. Okay, and there's a reason for that. So let me first give you the definition for the funds from operation, and then we'll talk about why they talk about FFO rather than EPS. Basically, FFO, that is very, very vague in general, but it's counting earnings plus depreciation and amortization. Okay, so FFO is basically your accounting earning, which is your EPS, and then they take those EPS and they add to that your depreciation and amortization. Now, why do you think they do that? The reason they do that is because in the case of real estate, a very, very big part of what brings down their accounting earning is depreciation, because they own real estate, and real estate by nature and by law is allowed to be depreciated very, very fast. So basically, if we look at their earning per share, it's going to say that they made very, very little money because they made a certain amount of money and then they can depreciate by a very large sum. So it looks like they make very little money. So it's not really a true representation of how much money they made. So basically what we do is that we add back this depreciation or any amortization if they pay down any debt, which again, it's not amount that left the firm, it's amount that, yes, they pay somebody in order to owe them less, so it's kind of a wash. So the idea is that we're really taking their accounting earnings, which is the EPS, and then we add back depreciation and amortization because those are not real expenses. We want to make sure that we are putting them back in. For other companies, accounting earnings are a lot better measure because, yes, they don't own much real estate, and the things that depreciate roughly resembles the value. So yes, I mean, if you can depreciate cars over 5 years, it doesn't mean that cars are worth zero after 5 years use them, but, you know, if you're a company and you drive 30,000 miles on a car for 5 years, it's basically worth zero, or very close to that. If you can depreciate your computer over, I don't know, 3 years or 5 years, yeah, maybe your computer is not worth zero after 3 years, but basically close to that. So for many other companies, the way they depreciate things is not an exact, but it's an estimation of really what things are worth. In the case of real estate, it's a bad estimation. You just say that the thing's worth less, but actually if they're maintained, they're worth the same or more. So we want to make sure that we bring it back. So all the estimations that those companies are providing are done at the FFO level, not at the EPS level. So that's how they report.
But
Yes?
they have to distribute that as part of their 90% rule.
No, they only have to distribute 90% of their taxable income. Okay? They don't even have to provide FFO. FFO is not something they tell the IRS about. Not because it's secret, it's because it's a number that is easy to work with for people from the industry that try to value them. That's why they talk about this, but it's none of the numbers they report to the IRS when they're reporting earnings. It's basically a number that is used for the industry. So yeah, you do not base your distribution on that. Tell you basically what this company, so this Real Estate Investment Trust owns, develops, and manages retail real estate, primarily single-tenant building throughout most of the U.S. Okay, so basically what they do is that they are specializing in retail. They have it in many places in the United States, and in this case, they're usually pretty high quality retails. So again, if you want to have exposure to retail in different places in the United States, this is one option. And you can buy another company that has apartments in different places, and another one has industrial, and so on and so forth. But this is basically a short description of what they do. Reporting they're evaluating based on FFO. The way that they value those companies, and we'll spend time the second half of the class valuing them a lot better, but basically they're putting a certain multiple on the FFO. Remember, in finance, usually when you talk about stocks, you put a multiple on earnings, and when you talk about real estate, you're using the cap rate. But really, multiple is 1 over cap rate. For example, if I have something that is selling for a cap rate of 5, so I have an asset that is generating NOI of 1 million, NOI, cap rate of 5%. 1 million divided by 5% is 20 million. So the value of the building is 20 million. A different way to say that is that the multiple of the building is 20, because it's selling for 20 times 20 million relative to the NOI. Okay, so you can call it 5% cap, or you can call it a 20 times multiple. It's the same thing. 1 over 0.05 is 20. Different people from different industries are using different terms. It's the exact same thing. Here, they're using multiple because they're still in the stocks side of investments. And basically, the way that they do is that they say, okay, so we're applying a 24.6 multiple to what they think that they're going to make next year. And they say, okay, 305 is what we think we're going to make. We're going to apply 24.6. This times that is what the target price is. Basically $75. This times that. The question comes that, okay, so we can kind of figure out how they come with 305 based on what they made last year and what the projection for rents and all that. You can estimate this. This one is a lot more difficult. So how they come up with 24.6? And first of all, the short answer is that it's a bad and primitive way to evaluate real estate investment trust. That's why I'll show you how to evaluate differently, and that's why you're also going to do it in the exam. And the slightly longer answer of why they use 24.6 is because other similar companies with similar type of assets are selling for a multiple of around 24.6. So they think that it's also appropriate for that. just like we do in real estate. So other properties that are similar quality are selling for a cap rate of 5.5%, so it's also appropriate for your property to have a cap rate of 5.5%. So basically, it's kind of a comparison approach. Questions?
Can the GRM, can you use that as another way to like show value of the property as well? Or cap rate the only way?
Can, but it's not as sophisticated as cap rate. In terms of earnings, how much money they made every year. So, for example, in 2006, they make $1.05 per share, $1.03, 91, 95, and they had some rough years, and then they came back to basically $1.09. How much they pay in terms of dividends? Remember, dividend has to be at least 95%, 90% of what they made. So if they make $1.09, they have to pay at least 90% of that. Well, they paid $2.28, and then when they made 71 cents, they paid $2.18, and when they made 76 cents, they paid out $1.78. So in this case, whatever they pay in dividends, those numbers right here, are actually a lot higher than what they generate in terms of earnings. So they have to pay at least 90%. In this case, they pay a lot more. Remember, the reason that they can pay a lot more is because some of the expenses are not real expenses. So they can pay it out if they want to. For many other companies, if you look at the payout ratios of, for example, if you think about payouts of other companies, think about a company like their earnings. Okay, so for example, in the case of Altria, their earnings are $2.88 per share, and out of these $2.88, they pay $2.26. They pay a very large amount because Altria is in the business of making cigarettes, and basically there isn't too much innovation in cigarettes for like 50 years, right? They're the same. So there's no really reason to keep money in the firm. They make money, they just pay it out to shareholders. So they don't need to invest that much. If you're looking at companies like Apple is in different situations. So they're in the situations where, on one hand, it's an industry where there's a lot, of course, to invest and develop and have new products and all that. On the other hand, they have a lot of cash on hand. So they are distributing some of their money, but not the vast majority of that. So, for example, in this case, their earnings are $8.58 per share, and the dividend is about $2.13, so about a quarter. Okay, so they pay 25%, they keep 75%. And then if you're looking at companies like Amazon, or even Google, they pay none. You check the numbers, they pay nothing. Well, first of all, Amazon doesn't really make any money yet. They are now in the verge of starting to make actual profits. So the EPS here, in this case it's 402, but the dividend, there is none. Okay, so in this case, in the case of companies like Amazon or Google, whatever it is, they return 100%. They could not, of course, be qualified to be a REIT. First of all, because they don't pay enough dividends, but of course also because of the things that they hold. So this is about return earnings. Going back to this report, really there isn't too much that I want to show you there. But yeah, basically this is what the report looks like. I just want to point out a few things. If you are, you have another report on Blackboard that is on Annaly mortgage, and Annaly is the other kind of real estate investment trust. It's not the equity, it's the mortgage. So again, this passive mortgage REIT own manager portfolio of agency mortgage-backed securities and provide fixed income asset management. So again, they do not own any real physical real estate assets. They actually own paper. In the case of mortgage REITs, they do use EPS. They do not use FFO because, again, those companies do not have depreciation. They don't own physical buildings, so they don't depreciate. So reporting EPS rather than FFO is okay. But those companies that basically all they own is buildings and those depreciate a lot according to accounting rules, it doesn't make sense to report EPS. It makes sense to report FFO. Since I'm on Annaly, I want to do one more thing before we will take a short break and then do some valuations, which is relevant for your exam. I want to show you that in the case of Annaly Mortgage. So Annaly Mortgage is the type of company that basically own very high quality mortgages. So they require their people that basically borrow money to have very high DCRs, very high credits. They lend against very high quality properties, etc., to make sure that basically they are going to get the money back. Okay? On the other hand, you have other companies that do it the other way and basically give money to everybody. Okay? Not so much now, but it used to be in the 2000s. They give money to everybody. It's like, okay, you don't have much down payment, so you don't have to have a high quality property. You don't have to have much down payment. You don't have to have skin in the game. You just basically, you want to borrow money, we'll lend it to you. And the idea behind it is that if you don't pay us back, we'll just take your property from you. Except that when you think about the case that, yes, you not pay the money back, we'll take the property for you, but the property is not worth nearly as much, so we are in trouble. So one of those companies was Novastar Financials. And Novastar Financials, I was confused which one is which here. Novastar Financials. Okay, Novastar Financials. This is basically a comparison between Novastar Financials and Annaly. So if you think about it, Annaly Mortgage that hold those quality mortgages during the period going 2000 till 2006, if this is 0% here and this is 500% here, this is about 100, 150%. Okay? They basically made over 100% in 6 years period, which by itself is big, and at the same time, they pay a dividend of about 12% per year. Think about it. If you double your money in 6 years, just the rule of 100%, which doubling your money in 6 years, the rule of 72 will tell you that basically that's 12% return. And then if you pay another 12% dividends, you made about 25% every year for those 6 years. It's very, very high. Very, very high. On the other hand, you have Novastar Financials that give money, loans to anybody. Well, this company was making during the same period about 2,000% not 100, 150, but about 2,000%. And at the same time, their dividends average about 18% per year. So forget about those numbers, you forget about dividends. 18 is small change. 2,000% within 6 years, that's huge. And the reason that I'm showing you that is because I actually personally know those, so maybe I knew some billionaires. I know people from Novastar Financials because they're based in Kansas City, and I was teaching at the University of Kansas. They were big supporters of our university. They gave us a lot of money, and when I was teaching real estate class, they came to my class and spoke to my students about what they do. And basically the story is that we give money to everybody because we believe that everybody should have the right to all this, blah, 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 blah. And if they don't pay it, we can just take the houses back and everything is great. And I'm sitting there, I'm not even a professor yet, I'm a PhD student. Those people give a lot of money to our school, and I'm not going to be there and be like, well, don't you think there's a problem in your plan? So, everybody is copying and all that, except that this company was in trouble, basically went bankrupt within 1 year after the Great Recession. So basically, if you had $1,000 and you made 2,000% of that, so 100% will be, what did you say, $1,000? So $1,000, 100% will be 2,000, 200% will be 3,000, and then 1,000 on top of that. That's a lot of money, and I'm confusing myself now with the numbers. Basically 20 times, right? Yeah, 20 times the money. Whatever it is. If you have some amount of money, you made 2,000%, which is basically 20 times the money, and then lost everything within 6 to 12 months, it's basically the idea of this risk-reward relationship of, yes, if you invest in risky things, you're not always necessarily going to be rewarded with high returns. You're going to be rewarded with high returns when things are going well, but when things are not going well, you're basically going to lose everything. So in this case, the reason I took this snapshot is because this company does not exist anymore. They went bankrupt, so if you look today for Novastar Financials, you cannot find them because they're not there. So that's kind of the difference between the philosophy of giving money to everybody. Now, during the same period, by the way, if you see here, from this point to that point, actually, Annaly Mortgage actually did pretty well. They actually took advantage of all those junk mortgages that were circulating around and selling for really, really, really cheap money, and actually made money with them. So if you even go forward till 2012-13, Annaly Mortgage did extremely well because they really took advantage of those other people that gave money to everybody, went bankrupt, and then they bought them for very, very cheap. So I guess this is a lesson in high risk, high return, maybe. But remember I told you the very first class, take risk, don't take too much risk. These are the kind of people who just basically take too much risk. It just doesn't make sense to give money to anybody. All right, so it's 6:54. Here's what I'm thinking. Please, 30-minute break today to make sure that we have enough time to value that, because you want me to show you how to value that, and cover briefly the next topic, and maybe answer general questions about the exam, and having a drink. Okay? So let's be back here in the class at 30 minutes, whatever it is.